In the early 18th century, Britain was riding high on imperial expansion and trade. But amid this prosperity, a company promised unimaginable riches from distant seas, luring investors into a speculative frenzy. Shares skyrocketed based on hype and rumor, only to burst spectacularly, ruining thousands. This wasn't just a market crash, it was a lesson in human folly, greed, and the dangers of unchecked optimism. This madness predated Wall Street crashes or dot-com bubbles. Centuries before apps and algorithms fueled hype, a single company's stock became the obsession of a nation. People from all walks of life bet their fortunes on promises of wealth from the South Seas, only to learn that speculation built on air inevitably popped. To grasp the South Sea bubble, you must understand the era it engulfed. Post-war of the Spanish succession in 1713, Britain was burdened with massive national debt from years of conflict. The South Sea Company, founded in 1711, was granted a monopoly on trade with Spanish colonies in South America. In exchange, it proposed converting government debt into company stock, promising profits from exotic goods like slaves, silver, and spices. London buzzed with newfound wealth from global trade, but beneath the glamour lay fiscal desperation. This period was dubbed the Age of Speculation, not enlightenment, but illusion. On the surface, it shimmered with opportunity. Deep down, it masked vulnerability. Debt wasn't just numbers on ledgers, it was a national crisis. The company's scheme wasn't hidden, it was celebrated. Aristocrats, politicians, and common folk alike poured money in, dreaming of easy fortunes. Shares weren't just investments, they were tickets to social ascent. What set this bubble apart wasn't the wealth at stake, but how inclusively it spread. The rising merchant class observed the nobility's gains and yearned to join. Newspapers hyped the company's prospects, redefining prosperity. Security gave way to speculation. Gaps between classes narrowed in the fever of buying, not through labor, but through risky bets on future riches. This was the stage where cunning promoters took center. Company leaders, including figures like John Blunt, weren't mere traders, they were master manipulators. They inflated stock values through rumors of vast untapped markets, even though actual trade was minimal due to Spanish restrictions. Parliament's involvement lent credibility, but it was a facade. Insiders profited while the public chased illusions. Observers like writers and critics didn't fit the euphoric narrative. Raised in more cautious times, they viewed the frenzy with skepticism. Their outsider lens revealed what insiders ignored. Valuations detached from reality. They documented the hype without partaking, gaining insight into the psychological drivers of bubbles. Traditional finance assumed rational investors trading on fundamentals. They calculated risks and rewards. Bubbles were anomalies. But the South Sea spectacle defied this. People bought shares not for dividends, but because prices rose daily. Logic yielded to momentum. Excess wasn't error, it was the engine. Investors paid premiums for prestige, not profits. Extravagant lifestyles emerged, signaling success. Mansions sprang up, carriages multiplied. But it was theater, wealth on credit propped by rising shares. The goal wasn't utility, it was appearance. This wasn't random, it was systemic, contagious, inevitable in a connected society. The bubble showed investment wasn't about value, but validation. To prove savvy, to outpace peers. In a trade-driven empire, the ultimate win was profiting without sailing. Speculating expensively proved you'd transcended labor. This revelation extended beyond markets. When investing turns social, logic shifts. Prices ignore fundamentals. Demand fuels itself. Competition unending. No summit in a hype race, only separation. Bubbles transform economies from production to perception. Comparison boundless. Critics decried not wealth, but squander. Of capital, trust, lives. People strained to join. Societies prized hype over health. A system mistaking frenzy for growth. Here's the peril. As hype builds, sanity erodes. Safeguards fail. The grander the illusion, the sharper the distinctions. The costlier normalcy becomes. This wasn't innate flaw, but societal construct around greed and influence. Once embedded, it overpowers policy or prudence. By 1720, as shares peaked at over £1,000 then plummeted, the mechanism was clear. It dictated spending, judgments, drifts to ruin without contentment. It was called the South Sea Bubble. Not trade for gain, not investment for return, speculation for show, bets visible. The scheme mattered less than the crowd's gaze. A voyage not sailed, a fortune unreal. These announced ambition, cunning, escape from toil, signals masked as ventures. The power lay in simplicity. People responded logically to incentives. In a status-driven age, speculation was currency, invisible gains useless. So hype amplified. Beyond buys, time mattered, conspicuous idleness. Avoidance of toil signaled peak. Journeys, galas, pursuits fruitless, not respite, but proof work was choice. This flipped worth. Efficiency scorned, inefficiency elite. Affordable waste elevated status. Delicate items prestigious for fragility. Attire hindering work denoted class. Idleness prized for futility. Once seen, patterns emerged. Elites set norms. Tastes, conduct, triumphs, these seeped below. Elite show became bourgeois goal. Mimicry turned compulsion. Here the trap closed. Resources limited, but signals omnipresent. Compensation via debt. Stability traded for facade. Not luxury legitimacy. To fit. To evade lag. In visual success, obscurity equals defeat. This cycle, perpetual. No resolution, in rivalry. Always superior. Ever fresher, norms evolve. Speculation a conveyor, masked as advance. Quiet paradox. Prosperity intensifies pressure. Earnings rise, anxiety persists. Entry fees escalate. Old wins become standard. Fresh baits appear. Costlier. Exclusive. Draining. No apocalyptic end foreseen, but vulnerability diagnosed. Hype-driven economies misallocate. To flash, not fortitude. Investments in image over safety. Costs hidden till crisis. Borrowing routine. Thrift sidelined. Peril behind polish. Mutual surveillance makes exit risky, not mere loss stigma. This resonates today. Bubbles formalize what contemporaries sensed. Prices can defy gravity till they don't. High values draw, not deter. When worth is prestige, cost is feature. Thus, monopolies thrive. Not justifying superiority, implying it. Rarity. Hush. Belonging if grasped, exclusion if not. Contemporary finance didn't birth this. Perfected it. Bubbles engineered, not erratic. Tech supercharges. Social platforms industrialize speculation. Visibility perpetual. Bets curated, shared, profited. Even caution becomes content. Core, unchanged. Only veneer shifts. Real tolls. Lifestyle creep, match gains. Obligations swell with wealth, not decline, but elusive targets. Comparisons ceaseless. Fundamental. We benchmark socially. Comparison engines potent. Here, finance meets might. Systems not just facilitate, rely on frenzy. Loans bridge gaps. Ads sell identity. Brands vend inclusion. Growth brittle, needing perpetual chase. Nothing screams stability, like perpetual inadequacy. Not anti-prosperity. Caution subtler. Societies mixing flash with worth breed signal. Chasers. Freedom elusive. True riches audience free. Buys autonomy, durability. Undervalued in spectacle systems. Revealed centuries ago. Not blame, but illumination. See the tech, opt in or out. History echoes incentives. Grasp them, or they steer you. If this shifted your view, subscribe. History holds keys, I'll guide the search.